Volvo is facing slowing sales, but the full picture is more complex. While revenue declines, profitability remains surprisingly strong. Let's break down what's really happening behind the numbers. We are discussing on the FinTalk channel.
Welcome back to the Deep Dive, everybody. I'm really glad you're joining us today because we are looking at something that honestly feels like a corporate magic trick.
Yeah, it really does.
Right, because we've got our hands on the Volvo Group's official Q1 2026 financial report. And, I mean, it is a dense document. But our mission today is to translate all these spreadsheets and financial jargon into what is actually a pretty wild story about global trade and economic survival.
Absolutely. And it's a story that applies to almost any business right now.
Exactly. Because, well, let's just look at the raw numbers in the first 3 months of 2026.
Yeah.
Volvo sold 11 billion Swedish krona less in goods and services than they did during the exact same period last year.
Which is a massive drop.
It's huge. They went from 121.8 billion krona in net sales down to 110.8 billion. And, in basic business physics, losing 11 billion in top-line revenue means your profits should just fall off a cliff.
Oh, totally. You'd expect them to be bleeding cash.
Right. But, okay, let's unpack this, because if we look at page 1 of this report, Volvo's adjusted operating margin, so their actual profitability, it didn't crash. It didn't even just stay flat. It actually increased to 11.0%.
Yeah, it's incredible. And to really appreciate that 11.0%, you have to look at the macroeconomic backdrop of Q1 2026. I mean, it was brutal out there for global logistics.
Pretty hostile.
Right. You've got the ongoing conflict in the Middle East, which is severely disrupting maritime choke points. That throws supply chains into absolute chaos.
Yeah, nobody knows when their parts are arriving.
Exactly. And then you have incredibly volatile energy prices, which causes transport operators to just freeze their capital expenditures. Add in all these shifting trade policies and new tariffs popping up overnight. And, well, it's an environment designed to crush manufacturing margins.
Which just makes that margin bump even more baffling.
Right.
So we really need to figure out how they kept more cash while selling fewer things. Because the headline says net sales dropped 9%, but then the report also points out that organic sales growth was actually up 2%?
Yeah.
I mean, that sounds contradictory right out of the gate.
It does sound weird, I know. But it really comes down to how global companies have to report their money. That 9% drop in total net sales, that includes currency fluctuations.
Okay. Right.
Because when you're a Swedish company, but you're earning billions in US dollars or euros or Brazilian reals, those currencies swing wildly against the krona. So it distorts the actual volume of business you're doing.
Oh, so organic sales growth strips all that out.
Exactly. It strips out the currency effects, and it also ignores any revenue from companies they just bought or sold.
Yeah.
So you're looking purely at the core business volume, and that core volume was up 2%.
Okay, but even that 2%, the composition of it is where the real secret is, I think. Because if you look at the vehicle sales the actual physical trucks rolling out of the factory, that volume was basically flat. Organically, deliveries actually dropped by about 3%.
Right.
But then you look at their service sales, and those increased by a massive 6%.
Yes. What's fascinating here is that Volvo is demonstrating just absolute earnings resilience. That 6% bump in services is basically the shock absorber. It generated over 12 billion krona in adjusted operating income for the quarter.
12 billion just from services.
Yeah, because think about what happens when macroeconomic fear hits. Fleet managers do something very predictable. They delay buying brand new expensive trucks.
Because credit is tight and everyone is scared.
Exactly. But the global economy still demands that stuff moves from point A to point B. So those fleet managers, they have to run their existing, older trucks longer and harder and over way more miles than they originally planned.
Oh, I see, which accelerates the wear and tear.
Exactly. Suddenly, they need more replacement parts, more preventative maintenance, more software diagnostics just to keep the old fleets alive.
It's essentially the printer and ink strategy.
Oh, that's a great way to put it.
Yeah, just scaled up to, 40-ton commercial logistics. The physical truck is the printer. It's super capital intensive, highly cyclical, and the margins are constantly getting squeezed by raw material costs, like steel and aluminum.
Right. The metal is expensive.
But the proprietary spare parts, the ongoing maintenance contracts, the telematics, that's the ink. That's where the steady money is.
It is. The margin on a software diagnostic tool or a specialized engine part is exponentially higher than the margin on just assembling the raw metal of the chassis. So as Volvo's revenue mix shifted naturally away from the low-margin printers and heavily toward the high-margin ink, their overall group profitability just floated upward.
Wow, they didn't even need to sell more trucks to make more money.
Nope. They maintained disciplined cost control, but really they just needed the existing trucks to require more support.
I mean, if you're a listener running your own business right now, this is such a powerful lesson. When the shiny new products stop flying off the shelves, you have to ask yourself, how robust is your recurring revenue? Because that service side is what actually protects the balance sheet.
It completely insulates them. But I will say, while that service surge explains the overarching financial picture, it definitely masks some massive, violent swings in their physical hardware business, depending on where you look on the map.
Oh yeah, the regional discrepancies are wild.
Yeah.
Let's look at Europe first, because Europe seems to be acting like the anchor here.
Yeah, Europe is holding steady.
It's a solid replacement-driven market right now. Volvo captured a 19.3% market share in heavy-duty trucks there. Order intake was up 2%, and actual deliveries were up 17%. So Europe is totally stable.
Very stable.
But then you turn the page to North America, and it's like a different planet. Deliveries in North America crashed by 34%. They dropped to just 9,486 trucks.
Yeah, and a 34% drop in a major market is usually a huge red flag, especially when you factor in the tariffs.
Oh, right, the tariff.
Volvo took a net negative hit of 1 billion krona purely from increased U.S. net tariff costs, and about half of that slammed right into their construction equipment division.
Because of the imported steel and aluminum.
Exactly. It directly squeezed the margins on equipment that relies on global supply chains.
Okay, here's where it gets really interesting, though. Because deliveries crashed by a third, and tariffs ate 1 billion krona. So you'd think the U.S. market is just dead.
Right, you'd assume nobody is buying.
But the report shows North American orders skyrocketing by 78%. They took orders for over 18,000 trucks in a quarter where they delivered less than 10,000.
It's quite the paradox.
And the official text blames a, quote, weak freight environment. But how can a market be weak if orders are up 78%?
Well, it forces us to look at the operational reality on the ground. How are you reading that order spike?
Well, I think it's like a stretched rubber band. The deliveries crashed not because fleets didn't want Volvo trucks, but because of severe supply chain and production pauses. The report specifically mentions stop weeks in their North American production system.
Right, the retooling.
Exactly. They were retooling the lines for the rollout of the all-new Mack Granite and the Mack Keystone models. They literally couldn't push the physical metal out the factory doors. But meanwhile, the demand is pulling forward. Customers know the new models are coming, so they're placing orders to hold their spot on line. The supply is pinned back, but the demand is snapping hard.
And that backlog is going to explode once production normalizes. But we also have to unpack why that underlying U.S. demand exists despite what the report calls a weak freight environment. Because it comes down to this concept of capacity normalization.
Okay, break that down for us.
So during the pandemic boom, anyone with a commercial license was basically buying a truck to cash in on those historically high shipping rates, right?
Oh yeah, supply completely flooded the market.
Precisely.
Oh.
But now, with high interest rates and expensive diesel, a lot of those smaller, over-leveraged operators are going bankrupt. They're leaving the market. That's capacity normalization.
The excess trucks are evaporating.
Exactly. And as those smaller players drop out, the U.S. freight spot rates, the cost to ship a load, start to rise again for the surviving companies. So those surviving mega fleets are now highly motivated to buy the newest, most fuel-efficient trucks. They're ordering today for the consolidated market they expect tomorrow.
Wow, okay, so that's North America. But we have to talk about South America, specifically Brazil. Because the environment down there isn't just tough, it is actively hostile.
Brazil is the ultimate stress test for Volvo's strategy right now. The total Brazilian heavy-duty truck market shrank by an astonishing 21%.
21%.
Yeah.
1 in 5 potential sales just vanished. Gone. And from what I gather, that's largely driven by monetary policy, right?
Right.
Because you don't buy a fleet of haulers with cash. When the Brazilian central bank holds interest rates that high, the monthly finance payment on a new truck just skyrockets. Add in the energy costs, and fleets just freeze.
They do. It creates a total freeze across the sector. Yet, despite the total market collapsing by 21%, Volvo retained a dominant 23.8% heavy-duty market share in Brazil.
Which is just a masterclass in holding your ground. When the pie shrinks by a fifth, but you keep your exact same slice, it proves your customers aren't running off to cheaper competitors.
No, they're staying loyal.
And I think it points directly to their dealer network. If a Brazilian logistics company is fighting for survival, they're not going to risk their business on some unproven, cheaper truck that might break down in the Amazon without any spare parts nearby. They stick with the incumbent who guarantees uptime.
Absolutely.
Yeah.
But guaranteeing that uptime takes serious capital, which is why we need to look at how Volvo's management is shifting their money around globally. Because surviving this kind of regional volatility requires really aggressive capital allocation. You have to prune the tree cut, the dead weight, to fund the growth.
And there was definitely some blood on the floor in Q1. Volvo made some ruthless strategic moves. I mean, the biggest shock is closing down the Rockback business.
The Hauling Solutions division.
Yeah, those massive off-road dump trucks used in mining. And it wasn't a small operation. Rockback generated 1 billion krona in revenue in 2025.
A billion krona.
A billion. And they just killed it. They took a 678 million krona hit to their Q1 operating income just to shut it down. And on top of that, they initiated these group-wide cost savings that cut another 812 million in costs, reducing their headcount by about 900 employees globally, mostly in Sweden and the US.
Yeah, it was a heavy cut.
So my question to you is closing a division that brings in 1 billion in sales a sign of corporate weakness? Or is it just a ruthless maneuver to protect that 11% margin?
If we connect this to the bigger picture, it is pure, ruthless capital allocation. Because revenue is vanity, but profit is sanity. Volvo is actively pivoting away from unsustainable hardware manufacturing. Heavy hauling is incredibly capital-intensive and hyper-cyclical.
Right, tied to mining booms and busts.
Exactly. So they're dumping that, and at the exact same time, they completed a massive acquisition. They spent a 7 billion krona enterprise value to buy Swecon.
And Swecon is a huge dealer network in Sweden, Germany, and the Baltics, right?
Exactly. So look at what they're doing. They're doubling down on the lucrative retail and service side in Europe. It perfectly mirrors that printer and ink strategy we discussed earlier.
Oh, they cut the low-margin printer factory to buy the high-margin ink store.
Precisely. And they're doing the same thing with their R&D. They agreed to sell 45% of their stake in Flexus SAS to Renault.
Flexus is the electric van maker, right?
Yes. They're sharing the engineering burden with a partner to streamline operations. They don't want to hold all the risk.
Okay, so cutting losses and sharing risk is half the battle. But the other half is funding the future. So let's talk about the powertrain pivot. What are they building next with all this freed-up capital?
Well, the shift away from diesel is the single most expensive transition in the history of transport, and Q1 had some huge milestones.
Yeah, let's start with electric. They officially launched the Volvo FH Aero Electric. And the headline here is a massive 700-kilometer range on a single charge.
Which is an engineering marvel.
So what does this all mean? Because 700 kilometers totally changes the math. Historically, electric logistics meant local, urban delivery, driving around a city and charging at the depot overnight.
Yeah.
But 700 kilometers crosses the threshold into real interstate freight. It essentially solves range anxiety.
On paper, it absolutely does.
But then here's the paradox. The report says that while fully electric deliveries rose by 17%, fully electric orders actually dropped by 15%, down to just 820 trucks. If the range anxiety is gone, why are orders down 15%?
Because the bottleneck isn't the battery anymore, it's the infrastructure. The broader drop in electric orders reflects massive hesitation among fleets. The early adopters, the mega corporations buying them for ESG goals, they already have their initial trucks.
Right.
But the next wave of buyers is looking at the grid. To charge a 700-kilometer battery fast enough for commercial use, you need megawatt chargers. Fleet managers are realizing they have to spend millions upgrading their own electrical depots, and the public charging network just isn't there yet. So the market is saturated for now.
Wow. And the report also mentioned that in places like China, natural gas is just dirt cheap right now. So fleets there are buying natural gas trucks instead, boosting alternative fuels but hurting electric sales.
Economics will always win the short game. Which is exactly why Volvo is not betting everything on batteries. The most critical move in this entire document is about hydrogen.
Yes, the fuel cell joint venture. So Volvo is doing on-road testing of heavy-duty hydrogen combustion engines. But the real earth-shattering news is the partnership. Toyota Motor Corporation signed a non-binding agreement to join Volvo and Daimler Truck as an equal partner in the cell-centric joint venture.
This is monumental. You have Toyota, a hydrogen pioneer, teaming up with two of its biggest global rivals, Volvo and Daimler.
Wait, equal partners. Three of the most fiercely competitive companies in the world just decided to share their secrets.
They had to, because engineering heavy-duty fuel cells is simply too expensive and too complex for any single giant to tackle alone. A commercial truck fuel cell has to survive brutal vibrations and extreme temperatures for over 1 million miles. The R&D costs billions.
Oh, I see. So if they all try to build their own proprietary hydrogen engines, they might all go bankrupt.
Exactly. By pooling their patents and their capital into cell-centric, they split the bill 3 ways. They build the incredibly expensive engine together in the back room, and then they install it in their own trucks to compete on the showroom floor.
That is just brilliant pragmatism. All right, so let's try to pull all these threads together. We started with what looked like a mathematical impossibility. Volvo navigated a 9% drop in sales, but they pushed their profit margin up to 11%.
Yeah.
And they did it through a brilliant 6% surge in high-margin services. They weathered that bizarre 34% drop in North American deliveries because they knew they had a 78% order spike waiting behind the factory doors.
Yep, the rubber band is snapping back.
They ruthlessly cut the billion-krona Rockback division to buy the Swecon dealership network, locking in retail profits. And they formed a superpower alliance with Toyota and Daimler to figure out hydrogen. It's an incredibly choreographed corporate defense.
It really is. But this raises an important question for the entire industry going forward.
Okay, lay it on us.
If services, retail networks like Swecon and software are becoming the primary drivers of profit resilience, while the physical trucks and their insanely expensive fuel cell developments are basically being commoditized and shared among rivals, are we rapidly approaching a future where heavy-duty trucks are essentially sold at cost, or even as loss leaders?
Wait, you mean selling a multi-million-dollar truck at zero profit?
Exactly, just to trap logistics companies into century-long data and service subscriptions.
Oh, wow. So the physical truck just becomes a Trojan horse for a service contract.
Exactly. You're not buying a truck, you're buying a mobile software agreement.
That is a terrifying and brilliant thought to end on. Well, thank you all for joining us on this deep dive. It just goes to show you really have to keep looking beneath the surface of the headlines. Take care, everybody, and we'll catch you on the next one.